Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Welcome. It's Friday and we got retail sales. So the market has kind of escaped anything dramatic happening quite a few times this week, but I think the retail sales might do it. There are some whisper numbers that I'm hearing about this number that could make it a big deal, and they're not good, by the way. So let's just come and look at the charts. I think the market might suspect something. What's wrong with my soybeans chart there? That's weird. Well, we'll fix that in a second. We'll fix that after the news. So when we come here into the S&P 500, it wasn't a very good day yesterday, and now again in the overnight, it's pretty awful. And I'm wondering, so one of the things that's going on is we're getting like shutdowns in China again. So concerns about the global supply chain are really up there, and it's kind of a problem because that means more inflation that the Federal Reserve can't necessarily do anything about unless you're just going to send the economy into a recession, right? So yeah, and you can see here in the treasuries are actually kind of mixed both ways. Yesterday, that turned into a really strong buying trend. I'm really not sure what caused that, but it did continue after we left. It was a really solid trend, but not one that we saw. Oil took a little bit of a hit yesterday too, but then recovered quite a bit overnight. But you know, they're trading back and forth there, so there seems to be two sides to this. We may need to keep a close eye on oil again as a possible indication of the economy. Natural gas came back big time after that huge run that they had the day before, so that's good. Gold and silver still within their ranges. Metals having a little bit of a problem. So when I see copper coming down like that, that's not a good sign, right? Then coming over into the Bitcoins. Bitcoin turned around yesterday, actually had quite a bit of a dramatic sell. There's some interesting things where we're seeing like they will print money and it will go up as they're printing money, and then as soon as they stop, goodish. So something weird is going on over there and it's not necessarily good. Yeah. Okay, so I'm having an issue with something on my data here. I'm gonna try restarting NinjaTrader here. I'm probably gonna have to kill it. Actually, no, let's not. We only have 2.5 minutes, so it's not preventing me from getting ES and ZN data. So we can maybe try and fix that at the top of the chart. But we're not gonna get our synthetic dollar index for whatever reason. This is something is hung. When I come over any chart, it's just, see, you get the little, it's okay. And get that up over there. Okay, so the number that we are looking for here, US retail sales month over month, the expectation is negative 0.1. Previous was 0.3. The whisper number that I'm hearing is negative 1.3. So this could be really bad. We'll see. But you know, that stuff hasn't necessarily been reliable in the past. Let's just keep an eye on it here. See what it comes out. If it comes out, maybe we need to come in and take a trade here, right? So Here, 30 seconds. Okay, you can see pretty much all of the liquidity pulling here. It's like we're a little late. Oh, oh man, that number is really bad. Oh my gosh. Oh man. The ES is not reacting here? Well, this is interesting. Hold up. The dollar's going to get creamed here. Okay, so US core retail sales month over month negative 2.3 versus 0.1. Curiously enough, I'm not seeing a really strong reaction here in ES. I'm not sure what the deal is with that, but that is a very concerning number. Retail sales was negative 1.9. Core retail sales was negative 2.3. Hmm. Like, I'm really surprised that I'm not seeing this a huge reaction in ES. I'm kind of like questioning, questioning my data feed here. Prior retail sales numbers all revised a bit lower as well. I don't think the year over year was 16.95. I mean, that's not bad, but that is a crazy bad number. I'm surprised that the markets aren't reacting more than they are. I'm really surprised here. But you know what? We're gonna kill Ninja Trader here. Oh, it killed it. And maybe they'll react and they open, they're all asleep. I don't know. You know, the thing is that retail sales can have a big impact, but it's not something that I can think of a time where like we had a really monster market defining move off of retail sales either, you know? So I'm maybe making it into a bigger deal than it really is. But and I think that there was some anticipation that it was going to be bad. The thing is that it was a little bit worse than the whisper number, right? Man, ARK suffered 352 million in outflows on Wednesday before plunging to a 52-week low on Thursday, and the week is not over yet. Yeah. Hmm. Well, I don't know what to say here. I think that we just need to sit and watch it a little bit. I have some oatmeal here, so I'm going to try and eat that real quick. And let's just see what they do. I would think that the dollar would get hammered here, but yeah, look at that. It's not that bad. So I don't know. See, the treasuries are actually trying to sell down now here. That's I don't know, guys. I feel like I must be missing something big time. What happened? Okay, so just to review, we just had our retail sales numbers come out, and the month over month number was crazy bad. It was much worse than the consensus expectation. The treasuries did have an initial move that was in line with what we should see, which is that the treasuries move up, but then they fell back into the hole. And it was, I guess it's not unusual for them to like take off like that and then fall back into the hole and then go off later. But the thing that is really kind of throwing me off is the S&P 500 not having moved very much. Now, Nasdaq Killer is saying, you said it was whispered, so maybe it was already accounted for. I think that there probably is some of that going on here. I mean, when we come back and we look at the overnight chart for the ES, they were already short here. Like the ES had already fallen, right? But I would think that with a number that far off of expectations, we should still expect to see some orders coming in. And I would really expect that 10-year yield to come back at least to 1.7. So we may just need to be patient. But one thing I am seeing in here is they're saying retail sales dropped 1.9% in December as Omicron in and inflation surged. So Retail sales drop as Omicron product shortages and inflation crimp spending. So it may be that the inflation is part of the reason why we had it, and so maybe they don't want they still think that the Federal Reserve needs to increase rates. I don't know, man. I think of it this way, like, you got supply and demand, right? And the supply side got hit really hard. That makes prices go up, right? And then what we did in addition to that is we really boosted demand, right? And so the prices really, really went up. If we hadn't have boosted demand, then both of those would have just decreased and we would have had more of a recession. So if inflation is really a problem now, how do you solve it? Well, I don't think you can do anything other than decrease demand, which will be harmful to the economy. So you're kind of stuck in a hard spot. What do you do? What matters more, keeping the economy afloat or tackling inflation? Right? Now you can see there they're starting a little bit of a buy, and then they kind of fizzle out. That's I don't know. The behavior here, I don't think is completely in line with what I'm the flow that I'm anticipating, but we should give it some time. All right. Hey, YouTube Finance. Let's come over here and see yeah, how big of a miss is that historically speaking. Okay, so we had a similar miss in March of 2021. We've actually had a couple of misses like that, but most of those were like right at the beginning of the pandemic. And most of them were on the upside where it was much higher than anticipated. So, hmm, that doesn't completely satisfy me. Okay, so we are now seeing the S&P 500 falter here. All right. Big Toasty, do you know $1 million traders? Not like there's nobody that I'm speaking with regularly that has shown me an account of larger than $2 million. No, certainly met people that have traded big size, and I don't know how big their accounts are. And I've met institutional traders before too, right? People that you know the size of their account isn't really even a comparable metric, right? Because they're just trading the size of whatever the size of the order their client gave them, and it could be huge. They could be tens of millions of dollars. you know, so by the way, something I also saw in there, Rio de Janeiro to allocate 1% of treasury reserves to Bitcoin. I'm not seeing Bitcoin react to that, but that does sound like an unusual headline that could move them. Monday is a holiday. How normally the Treasury behave in a situation like this on Friday? It's a good question, Anwar, because it's something that we've had a hard time sorting out in the past. Because sometimes ahead of holidays, you will get really, really massive moves. Like before Thanksgiving would be a good example, right? This last Thanksgiving we had something like that. And sometimes they just kind of fizzle and nothing happens. With a retail sales number and one as big as this one, I would expect there to be a sizable reaction. I mean, we have been selling quite a bit here in ES. I'm wondering what the treasuries are doing here. If they think, well, because it's inflation that's causing the problem, that's not going to change the Fed's trajectory. I don't know. I am a little bit more concerned though for my stock portfolio today, right? Like if the Federal Reserve is tightening, and hey, I still think one increase, assuming that the data supports it still in March, it could probably still make sense, right? But there does appear to be growing evidence for the view that we may be tightening into a slowdown, that the economy is probably going to have a slowdown this year. I don't know how you deal with that. But maybe we just need to give the treasuries time. Maybe they're all watching me and they heard that I was confused, so they're like, well, let's just kind of wait. Maybe that's what happened. I don't know. Let's see here. Building material retailers continue to enjoy solid growth, with sales climbing 0.9% in December, up roughly 25% annualized over the last 3 months. Recall that in tracking estimates for GDP, this piece is excluded from consumption and booked into residential investment. In other words, says Forex Live on Twitter, U.S. housing isn't done yet. No trader bite this morning. That's okay. Okay. So, one thing I will say though about like holiday trading is that if something starts on on the trading day before a holiday, it often becomes a really big move, right? So, if it starts, it's kind of one of those what Bayesian sort of things, right? It's like maybe 50% of the time there's a big move before a holiday, but when there is a decent move that starts off of the news, then it ends up being a big move like 80% of the time or something like that, right? Okay, well, after that initial dip, which again could have just been them falling back into the liquidity hole after the news, we are starting to get some solid volume long, pushing us up into new highs. Oh, geez. Here in Utah, there was quite a bit of craziness happening over where I used to live. Yeah, I know exactly where that is. 2 juveniles are in custody Friday morning after police say they stole a car and led officers in a chase. Oh, wow. That was right. That was right by where I used to live. 4700 South and 3200 West. That was right where I used to live. You say it's not advisable to trade today. Well, one thing we should keep in mind is it is a Friday, right? We've often had difficult trading on Fridays, right? But we're getting a decent amount of market orders coming in long here. The market orders aren't like bullying the book yet, but if we push to another new high, get above 24 there, um, you know, we could start to see some fun action, right? That's my favorite is when it hits is when you got like that 30 33 17. I'm going to bet what we will see here is they're going to tick up. There will be some iceberging at 23 half and this 24. I'm not even sure that a full 3000 will trade there. Let's see. Okay, so 1488 absorbed at that time. Ticks back up. Another 1000. So they're being a little sly about it, but they are absorbing some contracts there at 23 half. That 30-year is really, really pushing. Look at that. S&P 500 seeing some really aggressive selling now. Like just in the last minute or so is a good 1,000 contracts selling. Well, looks like the 30-year backed off for now. Which footprint chart do you think? Well, I'm perfectly happy with the built-in one. Oh man, have you looked at ATAS? It has like 14 different types of footprint charts. I'm like, what? Why? 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 What's wrong with just the most basic standard footprint chart you can get? I don't see what's wrong with it. Okay. So now they're revving it. They're throttling that bid to try and scare them out. Okay, 1945. So I said it probably would be less than 3,000, right? 2,000 is still a decent amount, right? So that's not that did not trigger stops, I don't think. Yes, 4,600. Well, we're definitely headed that direction, aren't we? It's a pretty crazy overnight move. By the way, now that we did tick up through 24, you see that huge bid at 23 half? So for whatever reason, somebody felt the need to stack something there and encourage them to keep going. Sometimes that's just because, they just need a little help to get the trend started. But it could be somebody just trying to exit a position. Well, they pulled their order. Let's see if they tick back up at 24. It might stack back on there. You say the built-in one sucks. Okay, down tick 23 half, only 445 contracts. That's not a good sign. Well, it was definitely a spoof. Well, let's not call it a spoof. Like the thing is that if anything tries to trade into it and then it pulls in, then it's definitely a spoof, right? But it may have just been they thought better, and if we let price move around a little bit, it might come back, right? Or we might see an iceberg somewhere in here. At the moment, though, it kind of looks like it was a spoof to try and flip price, doesn't it? Because we are coming back a little bit. So here's the thing with a footprint chart, though, is that to me, footprint chart is more about higher level, higher time frame order flow, right? So a lot of the little extra features that we have like on our DOM here that really help us see what's going on, I don't feel like are as important in the footprint. Like I can come in on the footprint and I can just look at the numbers and compare and do that, and I don't need a feature to highlight it or draw it for me. But that's just my take. Is it really possible to watch all of those instruments at the same time? Well, yes. But the thing is, Ted, is that almost all of these instruments are very heavily correlated, right? So I don't necessarily have to focus on every tiny little tick. I just look over here. Let me turn my pen on. I'm going to reset. I'm going to recenter things here. So I'm looking here. I'm looking over here is what I'm really looking at. And if this ticks up, I should see this tick up and I should see this tick up, right? And then the only thing that I care about then is which one ticked up more, right? At the moment, they're fairly even. But what I'm afraid we might see is we'll move up and this one will move quite a bit more than this one will, indicating flattening. That's kind of what I'm expecting to see. So that's why we want to keep, that's why I was saying the 30-year backed off, right? So that's already half of the screen, right? These ones, I'm only looking at those if I'm like going to execute, because these are just going to do the opposite of these. The only difference is that this one, I want to see if this goes, how much does this go? Because this is actually like a 7-year and this is a 10-year. So that's right. Okay. And then there's these two over here, the ES, right? Which one is just the micro and one is the full ES contract. So those should always move in tandem with each other, right? So I don't even really look at the book on this one unless I'm executing an order. I'm always looking right here. And then I'm generally more interested in the correlation, right? So like what I can do is I can reset it. So remember I said I'm going to reset it here. And now what do we see? Okay. Well, the S&P 500 is actually maybe a little bit up since we reset it. The treasuries are moving up again, but it's actually the opposite of what I was saying might happen, we saw the 5-year moved up more than the 30-year did. The 30-year is only up 1 tick and the 5-year is up 3 ticks, right? But you don't have a correlation guarantee. Well, the treasuries are so similar that your correlation is a little bit of a different thing when you're talking about a treasury, right? It is extremely, extremely rare that you're going to see the 10-year move one way and the 30-year move the other way. They're almost always going to tick together, and one is just going to tick more than the other. Yeah, the micro and the mini are correlated by spread algos. I think no way to react so fast. Yeah, no, you're correct. You're correct. If I had my way, I would only have one of those up, but because I want to execute on the mini, but the data that I really want to watch is on the ES, I have to have both of them on there. I wish that it was the case that I could make it so that I'm watching the data on the E-mini, but if I execute, it executes over in the ES. But you know, hopefully Jigsaw will make a feature for that in the future, and then we could free up a little bit more room. Although as things stand right now, we kind of have room. We kind of have extra room. Like I'm doing this Vista chart. It used to be tiny and you guys couldn't even see it, but then we freed up some room, and plus it's cool looking. You did some fancy graphics adjustment on that Jigsaw. What is? Oh, are you just talking about the pen? So I use an application called Epic Pen. It's actually yellow, but to draw on it, I should use the highlighter. What we're looking for is some of these offers to pull, right? So that right there, only $9.97 to tick up at 24.5. Good sign. What we want to see is offers pulling out of the way, bids stacking behind it, and market orders smashing into them. You can use a trade copier, and I'm not sure how I would do that. I suppose I could do it on, maybe I could program something through NinjaTrader 8 so that if I put a sim trade on in ES, it will submit a real trade in MES. Maybe I could do that. I think I'll just wait for Jigsaw to do something. Oh, you're talking about the color scheme. Yes, I did. I changed it. I set that by hand. And the reason I did that is because the human eye is better at differentiating different shades of green. So I think that it's easier to kind of interpret that chart quickly if you're using the color green. So that's why it's set up like that. I'm all about the colors. It's kind of that bright greenish yellow is the hue that, people are most sensitive to, right? Then I also really like to do things in magenta. I don't have anything in magenta on here, but magenta is a really good color to use because it just really stands out to people. Yeah, I'm really happy with how it looks. And then the candles themselves are orange and blue because and I use orange and blue because those are better for colorblind people. Like if you do green and red, then there's colorblind people can't handle it, right? This blue and orange red is okay, but I kind of prefer it to be more orange. On Sierra charts, you have option to watch instrument A and execute. Yeah, okay, cool. I'm sure that Jigsaw will get those features soon. they've kind of been stuck working on their charts and building out their development team. And now that they've got things going, my understanding is that the next update in Jigsaw should have some interesting features. And then from there on out, I'm hoping that development is a little bit more consistent from Jigsaw. You know, it was like it started out as like one guy contracting it out to people, and they're in Indonesia, so it takes a little bit of time, I guess, to sort things out and get good programmers and stuff. Only I could totally write it myself. I 100% know what to do. The thing is I as of late, I'm not trading on MES very often, and I can just have both DOMs open. I mean, I have the room, so it's not a big deal. Oh, they got 3.2.5? Really? Let me go check out here. I didn't catch that there had been an update, so let's go look here. I mean, I saw the 0.2 one. He hasn't sent out an email about it. Did it happen today? Okay. Let's see here. Maintenance release fixed. When we zoom out footprint charts and move the chart around, we lose the zoom. Fixed. Partial fill issue with NinjaTrader 8 MT5 bridge. Oh, okay. Released today. Thanks for pointing that out, Dad. Since looks like that particular issue isn't going to affect me, so I think I can wait until after the stream is done to mess with it. But well, the treasuries sure look like they're on a strong upward trend now after that initial hitch. He was saying it's $100, so I'm sure that it's company. Could you create something like Jigsaw? I could, but it would take me a long time, and I don't think that it would be worth it for me. Like the thing is, if I went and I created my own DOM, would my DOM be significantly better than Jigsaw's DOM? Probably not. One of the things that you got to understand is all of the technical details around how you handle updates on a data grid, like a DOM is a really complicated thing. So, that's a really solid base that Jigsaw starts with, right? Now, if it was a whole platform, I think that I could make my own full platform. And there are a couple of ideas that I have that I think could give me an edge over other platforms. But again, it would take me a long time. For me to do that, I would probably have to, solicit investors and stuff and hire a few people. But I do think that going to like C++ or Rust, that we'd be able to make a more solid platform. There's a couple of things that are missing, like Jigsaw doesn't have a market analyzer. That's kind of annoying to me. I wish that it did like synthetic instruments or something like that. I also wish that it had a way for me to plug in programming in some way, like for me to run machine learning in Python. Although from some of the things that he said, we don't really know what he's going to do yet. But some of the things that they've said in their last blog makes suggests that we might see something like that. That was another thing. We remember yesterday we were talking about converting the indicators to Sierra charts. Like, I really want to do it. It's just that from the investigation that I've done, it's like I'm going to do it, and then 5 of you guys are going to use it. And, I barely have enough time to make the videos right now, unfortunately, right? So, but it also sounds like that Jigsaw is going to be creating things that will allow us to start programming stuff for it. And so probably we're going to want to focus on the Jigsaw stuff, right? So do you have your setups? What do you mean by that? Okay, interesting. Very, very interesting. So the Treasury just flipped around here and sold pretty hard back through that whole area where there was kind of contention. Hmm. Like the amount of sell in the 5 year there was quite excessive. The setups, well, so my setups are always going to be based more on uh me having a fundamental view on the market and seeing a favorable location, or at least a clean location for me to get in, right? So for instance, this one spot 721 is actually a pretty shitty position, right? And that was just because I heard the number and I clicked, right? But if I can use an iceberg or catching the edge to try and execute off of, that helps. If within the range, it's a good location within the range, I'll take that. But the whole thing is that I'm very actively trying to avoid the fallacy that past price is going to predict future price, right? So I don't look for some sort of a pattern in the price as that's the reason that I want to get in. I always have a more fundamental reason to think that it's going to go a certain way. You like the new thumbnail? Hey, thank you very much, Rick. I put a lot of thought into it. I'm expecting a sell off. I'm looking for a great spot to sell the 30 year. Oh, that's interesting. So why do you want to sell the 30 year? So here's my trade right now. The retail sales was a really big miss, and there is concern that we are running into a slowdown here at the first half of this year that is driven from Omicron and supply chain disruption. And we're seeing more disruption coming out of China. As such, it may be the Federal Reserve may not be able to tighten as much as they want to. The market has been pricing in 4 interest rate rises this year. The Federal Reserve has been saying 3. And maybe if there's a disruption, it goes even less than that. So even though I think that they probably still raise in March, although we've got a lot of data before then to see, but then the rest of the year, they might not be able to do that. And as such, the Treasury should probably reprice here a little bit and maybe come back towards like 1.7 even or something like that. And so that's why I'm taking the trade that I am. And what I'm doing here though is the order flow still very much matters to me, right? Because what I'm doing is I'm saying, okay, this is what I expect the flows to do. These are the current conditions in the book. So that allows me to predict. I can't just, I need more than just what the future orders are going to be. I need the future orders and the current conditions to know what price is going to do and to know how I want to play it. Right. So right now, this market is and you're going to see more about this in my video that I'm going to put out on Monday. Okay. But this is a market in the treasuries that is being driven by the market orders, both ways, in fact. And so because of that, it is creating some liquidity pockets that it's coming back on. So if I was going to take a new position, you know, if I wanted to take a new position long, the treasury, this spot right here is very optimal because they just slipped back into the liquidity hole that had formed at 24. So if we're going to continue going up, this is like a great spot to get in. Wow, somebody just bought 3,400 and ticked it up, right? So that's the conditions though, right? There's some strong market orders coming in. Okay, so Jamie Dimon is saying we expect more interest rate increases than the implied curve. That could be something that could push it the other way, right? You are the only fixed income streamer in the world. I may be actually. It may be true. That's why I put in the thumbnail bonds and equity index futures. I mean, to me, I just think of it as futures, but I honestly, this is kind of a weird thing that I mean, I guess I know why it is the way it is, but to me, I don't understand why you would trade futures and not trade the bonds. I mean, if you want to trade, focus on ES and only trade the bonds sometimes, like I totally get that, but the bonds are so news sensitive. There are just so many great opportunities in bonds. Yeah, those big boys will enter a range at times wide enough to stop most out. Well, I'm more so in this kind of a move, the thing that I'm concerned about is just getting stuck into the liquidity hole, right? Like the thing that I don't want to do is it comes down. This is the liquidity hole. And then I sell the bottom of the liquidity hole looking for a reversal, right? Because you could be stuck in that hole for a long time. And if the trend continues, you're in a really bad position, right? I think what may be going on here actually though is flattening. Do you notice how when they hit the 5-year, like when the selling came in, it really came into the 5-year. So that might have been flow to flatten the curve. And in the end, we still end up trending up in the treasuries. Yeah, fixed income is much better for people to get up and running. Yeah. I mean, you understand a lot about the markets when you do that too. If I look for your channel as day trading, futures trading, no pop, but as a subscriber, remember it's easy. Yeah, I for some reason YouTube isn't showing me as much, but I think that just has more to do with there's lots of competition, unfortunately. How they move the 5-year and 10-year, it is so strange. Well, they came in and sold like 2,000 contracts in the 5 year, right? It was more than that. It was almost like 6 or 7,000 contracts. It was mostly just in the 5 year though. So I don't know. Is that JP Morgan coming in and saying, "No, we don't care what the retail sales number is. We think that there's going to be more rate hikes than the market anticipates." That could be what's going on here. But you were actively searching for my channel, huh? I don't know. I there has been at times, we've suspected that we were getting like throttled or whatever or hidden from the search results, but that doesn't appear to be what's happening right now. So if I'm being, intentionally um, you know, throttled in the search algorithm, how am I supposed to know? What am I supposed to do about it? So you might be right, but it's not something that I concern myself with. The changing the thumbnails does appear to have helped. Yeah, you got a couple of new people in here talking today, and we've got almost 30 viewers, which is the highest that we've had for the week. So I think, again, one of the things that happened was after the GameStop thing, there's a lot more people streaming this sort of a thing, and we had more competition, and the thumbnail that I had before wasn't as good. And there's people out there that they take on a lot of risk, and that's kind of exciting for people. So that's kind of hard to compete against. I recommend to friends, and that is what I find. I mean, this Dom tenure where you have a trade, it is moving without market orders. Oh, right. Well, there have been some ticks, like you see back here where it was only 269 behind it, but there's still some big market orders coming through as well, right? I was thinking about getting back out over here, and I wanted to give it more time, and that was the wrong choice. The flow that we're seeing here is definitely not what I was anticipating. So I think I'm gonna try and, oh my god. All right, well, I'm gonna cut my losses here. That was nuts. I think I might want to stay out of this because somebody is putting a trade on here that makes zero sense to me. That makes zero sense to me. And they seem to be very influential here as well. Okay, so part of what happened there, Big Toasty, is that the 6J is getting hammered. The dollar is going up and the 6J is getting hammered. So I think that that's part of why you're seeing these ticks where it seems like it just ticks through it, right? Another thing is that because we had such a strong trend up and now we're immediately flipping back down on it, if there is some sort of a meta order short coming in here, they're going to have a little bit easier time for price. You say I told you this time, but you'd have no reason to say that. Other than I just feel like that there's more, that it's been that time. I don't know. I respect the serious way you have no games. Oh, thanks. I try to be serious about this. Now the question now is like, okay, so should we be buying here? This flow that we're seeing right now, that's got to be this JP Morgan thing. JP Morgan again saying that they think there's going to be more interest rate hikes than is currently priced. So this goes along with what Jamie Dimon was saying earlier, where he said, I'd be surprised if it was just 4. So in my mind, how do you get such a dismal retail sales number and get more interest rate hikes than anticipated? But sometimes the market's not rational, right? Maybe JP Morgan came out and said that because they have a position that's long interest rates and they're screwing with it, But that's why we just kind of have to have this thing of like, what is the flow that we're expecting and conditions we're expecting to see? And then if the flow that we get does not, is not in line with that, we need to just bail, right? Because we're not going to be able to predict every flow. Well, when you say 156.16 was just made to sell, there was, when we were up there was certainly something like they're probably going to need to come back a little bit. But from a fundamental perspective, I see no reason why they couldn't have, consolidated for a while and then made another push higher. In fact, even now still, I think that you could potentially see a visit back to the highs, right? With the way that the book is behaving and pulling out of the way on these moves, they could move back up to the high just as easily as they move down to the low. But again, since we're not 100% sure what's caused that sell meta order, and just to point out again, 6J moved down in correlation with it. There was a little bit of pulling, and that kind of tends to happen when it's more of a currency driven thing. And I did hear, over the news squawk, JP Morgan talking about this. So that's probably our best theory about why it's happening. Now, we could try to trade along with their order, right? But the question is just then, how much more is going to sell? I don't know if 20 is really your best risk reward location to try and take that trade, huh? What is, we got to remember that fundamentals don't move it, right? Orders move it. We can predict orders, and a piece like the retail sales missing really big time is something that can be very effective at predicting orders. But it's a really hard thing, and you're never going to get it completely right. Yeah. It's interesting if there was something in there that we could look at that could have predicted that we were going to get those sell orders. And that's what I'm saying. It's just, it wasn't in line with my expectations. So I'm trying to sort out why it might be happening. We have a couple of theories. Sometimes you just really know why it's happening, right? But a lot of the time in the treasuries, like the thing that's frustrating about trading and the markets in general is that there's like these different order flow forces out there, right? One force is people like me that are watching the news and the fundamentals and information that's out there, and they're trying to price that in to the instrument, right? But there are other people out there that they just have a fund that is supposed to be long bonds or whatever the deal is, and they rebalance their portfolio on a certain basis. They have to do certain things before the weekend. In other words, there could be a reason that a large fund out there needs to sell today that has absolutely nothing to do with any of the fundamentals, right? And what we're finding, or at least what I've seen from the research, is that mechanism where of uninformed trading is often much stronger than the fundamental information that's trying to be priced in, right? So we had a pretty strong sell in here. I guess the thing is that most people, like technical analysts, will say, well, the market's always right. That means something, right? That the market moved down. There's, well, not necessarily, because that flow that sold may not have any informational content behind it at all, right? So all of the theories that I just listed out for you about why they might be selling were kind of based more on, some informational content that maybe would push it down, right? But it could just be some rebalancing that we weren't aware of. That was Yellen speaking now. I don't know, man. Sure was a strong sell though, wasn't it? I think that part of what we're seeing right now is once we got below like 20 half, I think that a lot of people are trying to jump on the trend, right? So I have no way for me to know if this is going to continue moving down or what's going to happen. Here's the S&P 500 going in now. Do you ever look at how equities are correlated to the treasuries or divergences in news events, unusual movements in ES compared to the US? Yes. So the correlation between equities and bonds are very complicated, right? Because they change based on the moves. Sometimes they're very highly correlated and sometimes they're very divergent. As of late, because the market is concerned about rising interest rates, they've kind of been correlated, right? When the treasuries sell and interest rates are rising, it tends to cause selling in the S&P 500 as well. As of late, I've only been trading micros. I'll put like sim trades into ZN, but I've found that I'm just so much more comfortable just trading the micros. Like, look, I have a day job that I do quite well with being a software engineer, so I don't have to make tons of money from trading. Of course I take it as seriously as I can and I put as much effort into getting as good at it as possible, but I realize that it's not very realistic to expect to make all my whole living off of it. So it's better for me and my own mental state and just being able to keep trading if I'm doing poorly, that I trade micros. So ever since they put these micro treasuries out, been much more I've been much more interested in trading just those. Thanks. That's why I partially stopped looking at it. Right. Well, so here's how I would approach it, Patrick. Because if you're gonna look for a correlation as like a reason to buy or sell something, then it really better be something that is like directly arbitrageable, right? Like you want to be like between the ES and the MES, right? If you can buy the one and sell the other one, and they can cancel each other out, and you can arbitrage a tick difference between them. And if the MES goes one tick further than this one, then you might want to buy it, depending on what the trend is and all this other stuff, right? Man, they are just getting absolutely demolished here. So is trading more of a hobby yeah, I would consider it more of a hobby. And we're trying to put more and more effort into the YouTube channel itself, just because we've learned a lot of really valuable stuff from trading and things that I think this whole thing that we were just talking about, that not all flows have informational content behind them, that markets don't always get it right. I think that would change a lot of people's approach to markets. I think that a lot of the attitudes that we have in America about markets, a lot of the values and philosophical beliefs that we have around capitalism and stuff, are based on this mythos of the market always being right. And when you realize that markets are actually quite inefficient, that kind of demolishes that. Then you say, in order for the markets to correctly factor in all available information, it's up to us. We have to trade it, right? We have to put the orders in. You found it by searching for Dom live trading. Oh, very good. Because that's what I put. I changed a couple of things this week because I felt like that's what we need to be doing is we need people that are going to be interested are going to be searching for the Dom. So I put that in the title. Anyways, and there's lots of decisions even from like a regulatory level that are made based on this whole thing about the market being right or wrong, because markets are wrong sometimes. That means that we kind of have to protect ourselves against it, right? The problem with markets being right or wrong is you end up what's wrong with that. So here's my take. So a lot of people seem to think that trading is about seeing what happens and then reacting to it. So you have some function in your mind. Market gives you this piece of information, you do your calculation on that piece of information, and out of that comes a decision. And it's this rote thing that is based on the information that you're getting back from the market, right? My take of it on it is this: if you go and you do that kind of an analysis, especially using only price, but even if you're using full order flow information, that stuff is not very effective at predicting what it's going to do in the future, except on very, very short time frames that most of us retail traders aren't able to take advantage of, right? So I don't think that a trader's job is to follow what everybody else is doing. I think that a trader's job is to be the person that knows what's going on. I don't want to be the person that's following everybody else. I want to be the person that knows what's going on, gets in first, and everybody else comes in after me, right? Because if you were going to sell here, the earlier you sold, the better you would be doing right now, right? Now, could you have an opinion that is contrarian or wrong from what the flows are that are happening at that time? Yes, you very much can. And that's why you still need to be able to watch the flow, right? And see if it's really meeting your expectations or not. So that's all we did in this case. Can you imagine if I had stuck to my trade? I mean, I had kind of should have gotten out of it earlier, and I guess I wasn't as focused as I should have been. But I took a little bit of a risk on saying, let's let it go a little bit more. And then it really went and, and then it really moved just as I was trying to get out. So I lost another $4 off of that. Oh, well. Now, I still don't believe in the sell case. So I'm just kind of standing back and waiting if I see some sort of more of a reason to see maybe why it moved the way that it did. So there was some other numbers that were released, like there was the industrial capitalization rate and stuff. There is consumer sentiment at the top of the hour. I don't think that those capacity utilization rate or industrial production were significant numbers, though. How do you know that? Prove that. No one said that you can't have an opinion. I do say that it's not going to be helpful to trade profitably. How do you know that? Because here's my take is you have to predict orders. News and information is more effective at predicting future orders than price is. Right? Or rather, the market is more statistically efficient than it is informationally efficient. That's what the data says. So if the data is more statistically efficient than it is informationally efficient, then we're going to have an easier time finding an edge through information than we are through statistics. I think that where people get caught up is that they think that the fundamentals move the market, and that's not true, right? Orders move the market. So you don't just want to be looking at what are the fundamentals. The fundamentals say that the economy is doing poorly and that they won't be able to raise interest rates as much as they want, right? No, you need to go for more than that. You need to be looking for anything that could predict future orders. For instance, a model that suggests what risk parity funds are going to have to do in their end of month rebalancing, right? That could be something that could predict future orders, right? Information, in this case, information is going to be any piece of information relevant to the market that isn't generated by the market itself, which means anything that you're receiving that comes outside of your rhythmic CQG connection. That's what I mean by information. So it comes through your news feed, or you have your own model outside about information about how a risk parity fund behaves. Yeah. And you intend to scalp off of that? Yes. Good luck. Well, I think I've since I've started doing that, I've done quite well with it, actually. A lot better than because again, like the thing is, this take that like I'm going to look for a specific sort of pattern in the order flow and trade based off of that. I'm just telling you, I've done so many different things. I've done so many types of back testing. I'm not saying that order flow is useless. I mean, there's some edge to it, but again, markets are very statistically efficient. Markets are very statistically efficient. It's crazy hard to find an edge in that. It's almost impossible for a retail trader, just because of the cues and stuff, right? Most of what we see go on in the retail space, we were talking about this yesterday. Most of what we see that goes on in the retail space is either one, just following somebody that says something and just naively following somebody else, or B, naive empiricism, which means they think based on their very simple understanding of statistics and risk that they have an edge. But when you go and you really look at what data you would need to produce a statistically significant result, you will realize that doesn't work. Once you get a large enough sample, it doesn't work anymore. And that's because most of these stats that people are looking at don't factor in risk and fat tails. But my approach here, there's three things that are different about this stream. We're using order flow, we're trading bonds, and we have an empirical approach. So the data that we have says markets are very statistically efficient. You realize the insane competition and efficiency there is, but there's less than there is over the statistical sort of things that you're talking about, though. Like here's the thing. So for instance, here's a piece of a technically based strategy that has empirical backing. Okay, you can go and you can look at all of the different treasuries, and when they are out of line with each other, they're not completely moving in line with each other, you can try and scalp a tick out. Okay, so you can arbitrage. Arbitrage is an empirically backed strategy, right? There is an insane amount of competition for arbitrage strategies, and unless you have a co-located exchange with a robot trading that, you're probably not going to be competitive in that arena, right? But when we're talking about scalping information, again, the markets are very statistically efficient. But because of these big flows that come in, so again, if you go and you do a statistical analysis based on your order flow, price, whatever it is, you're almost always going to find that your strategy comes back to break even. Okay, right? But then when you go and you look at the current price, is the current price completely factor in all available information? No, it does not at all. The markets are not very informationally efficient at all. There might be a lot of people trying to trade off of that piece of information, but because there are other flows in there that happen that have no informational content behind them, the markets do not reflect all of the current price does not reflect all available information very well at all. It does not do it very well at all. Now, that presents a conundrum, right? Because on one side, there is an informational inefficiency that you can potentially take advantage of. But on the other side, there's going to be a lot of noise that will screw up your trade anyways, right? So what do we got to do? We've got to find situations where we can take advantage of those informational inefficiencies effectively, right? Where we know that the flows are going to come in our favor. And you could say, for instance, there have been times, really good example, it was like that first jobs number after the pandemic, right? Where we were expecting a negative jobs number and we actually ended up getting a positive jobs number, right? And so that's a pretty big informational inefficiency that the market was not anticipating, right? So yeah, you try and get in exactly at that moment. There's going to be a lot going on and stuff, right? But it moved up all day that day. It was a trend move, right? It was a trend day. So in that case, there's so much inefficiency. Can you, as a retail trader, pull a little tiny bit out of it out? Yeah, you can. It's really hard to do it consistently. It's always going to be hard. But what the evidence suggests is that it's going to be easier for you as a retail trader to find that inefficiency on an informational inefficiency than it is to find a statistical inefficiency. Everybody can go and see things. If you're following the news and you're following the market, everybody should see something that's not properly priced in the market. Everybody should be able to find something like that. Okay. There are people that are going to spend 30 years looking for a statistical inefficiency and never find it. And then when they find it, gets arbitraged out of the market. So that's what's happened with us, right? We found some statistical inefficiencies and they just didn't last for very long. But that's what we're about now. That I think so many retail traders want to say, don't pay attention to the news. Like, you don't need to know what the news release was, just to see how the market responded to it. And I disagree. In fact, if I can, I want to know what the number is going to be before it gets released and try and take a trade off of it. Today was an instance where we could have done that. I said that the number was, they were saying that the number was going to be bad. We could have taken that. Okay, so you're saying the problem is you're portraying from a very mechanical and algorithmic start, but that is why you talk about statistical edges without considering the artistic side of it and how it is. Okay, but what you're doing is you're taking trading from a empirical problem that we can solve and answer with empirical means to something that's more like, religion or art, and there is no objective standing on it. And at that point, all you can do is you can look at, so you can trade off of that, and maybe you're noticing something or you got to feel for something, right? And the only way that you can know that that method is effective is to try it for yourself for a certain period of time and see how well you do, right? And how many people do you know that are doing that? Do you know anybody that can give you like a 5-year track record of doing that and have found it effectively, right? Was along that move on what? On the ES? Oh, very nice, Salim. By the way, I did see your suggestions earlier. They're actually, I don't know, there are some reasons why maybe I might not do some of those things, but they're good suggestions. You don't know anyone who I do. You know, their top trader at Axia basically makes all his money like once a month off of trading macro news. And he's a person that's pulling like 7 figures. Not saying that they always do well over there at Axia, but that's one example of a person that's doing that. I think the reality is that day trading is always going to be crazy hard. No, you know why he hasn't shown me his bank statements, but you don't think that that's fair? You don't think that that's a fair example? So like a well-known prop firm? So I don't think that they're lying to me. Just I don't know. I mean, I can also say I know people if it comes to that. Yeah. Although I guess the caveat there is I don't know if that's a 5-year record though. That's where it gets really tough. Is like I've certainly, in myself included, periods from 6 months to a year to 2 years where you can do quite well. But like a 5-year record is like almost impossible to find. But again, the empirical evidence that we have suggests why that is so, right? The market is very statistically efficient. So anybody that's going in and trying to find a statistical edge as a retail trader is extremely unlikely to find it. And I mean, like out of 1,000 people that try and do it, maybe one person finds one that is capable of providing that kind of income over 5 years. Okay. Whereas when you're looking for the informational edge, probably almost everybody can find one, but there's still going to be order flow that you don't expect that has no informational content behind them that could potentially screw up the trade. So you're going to have to manage it. That's why it's really important to understand the DOM and the order book and how the market behaves based on the current liquidity conditions, right? For instance, in this instance, the inverse square law, or sorry, just the inverse sine law is a really important thing to keep in mind, was that we had a big meta order and then we had a meta order hitting back the other way. And because of the wake that the original meta order leaves behind it, when that other meta order comes in and hits it back the other way, it's really strong, right? That would be one thing that we can look at, for instance, right? But how do you know that sell meta order is going to come in? And I'm telling you, I've not found any statistical setup, edge, pattern, whatever, that reliably says that thing is about to happen. But I have found some informational edges that can reliably predict that sort of a thing is going to happen. And then, you get that thing that happens. For instance, here today, we did it, right? We got some flow in our favor. It was pretty good. Somebody else came in and ruined the trade. That's okay. That's going to happen. It was a good trade. What do you mean by a statistical edge? So a statistical edge would mean taking price, volume, orders, and doing an analysis of that to find some sort of aberration that is statistically significant to try and make money from it. That's what I mean by a statistical edge. That when you investigate the market, that because of the way the way that the market works, and what we mean by that is when you trade, it moves price. Orders move price. So if there's a statistical edge and you say when this situation happens, this instrument is mispriced by 4 ticks. It should move up by 4 ticks. You go and you can trade that, and we can actually calculate how many contracts you can maximally use, right? And once you've used that optimal number of contracts, that edge will be gone, right? And it turns out that it doesn't take that many contracts to do it. The number is a lot lower than you would think. And so statistical edges get arbitraged out of the market very easily. Well, I'm not going to say to somebody, you shouldn't go and try to look for a statistical edge. All I'm saying is look at the empirical evidence. The empirical evidence is that statistical edges are extremely difficult to find and take advantage of. I think, and again, that this is a mindset change from what most people that come into trading think. Most people that come into trading think that I just need to know the way that the market tends to behave. I'm going to find a trade that takes advantage of that, and I'm just going to consistently always do that thing, and that's how I'm going to make money. And that approach is fundamentally flawed because markets are competitive, because orders have impact. Any kind of behavior that you see out there, it's going to get arbitraged out. If it's caused by the market microstructure, and this is where it gets interesting, right? If it's caused by the market microstructure, like this inverse sine law or the square root law of meta order impact, it's always going to be there, but there's always going to be people trying to take advantage of it, and you have to compete for it. Or like arbitrage. Arbitrage would be another good example of a trade like that, right? They're based on the market structure. If it's based on like the way that people tend to behave or whatever, those get arbitraged out. And because when they get arbitraged out, they change the way that people behave. So any kind of statistical analysis that you do on markets, it is going to tend to be or appear to you to be equal to a random walk. And there's a very, very large volume of evidence that says that markets are very much like a random walk. And there's only been a few stylized behaviors that we've been able to find, right? Which include clustering effects, volatility clustering, the square root law of meta order impact, the inverse sine law, liquidity holes. Liquidity holes was the last one, right? Those are stylized behaviors of markets that we've shown empirically actually happen, right? Anything beyond that, you'd have to prove it to me, right? I do kind of find a conflict when you say orders move price from what you're saying. If you are paying attention to information, one might think the information is what moves price from your point. Well, you could say that, yeah, the information is what's moving it to some extent. You could say the information creates the orders, yes, but not all orders have informational content behind them. That's why it's much more correct to say orders move price, right? If you could 100% correctly predict the future orders, then you could 100% predict what price is going to do in all cases, right? And the more predictive that, if you have something, the more predictive it is of future orders, the better chance you have of being able to trade off of it. So liquidity holes do not get arbitrage out of the market. Well, so yeah, I would say that they do not. I mean, they still happen, right? It's unavoidable that liquidity holes will happen. I think that liquidity hole is kind of a slightly different sort of a thing, because how do you directly make money off of the liquidity hole? You know what I mean? The liquidity hole, if you're using liquidity holes correctly, really what it does is it just kind of saves you from taking a bad trade, right? It doesn't necessarily make you money. Wouldn't it be better to pay attention to the orders instead then? Well, I think that you need to do both, right? You need to watch the orders, but you also need to have things that predict the orders. So here's the retail sales number. It was a little bit better than expected, apparently. Sentiment was 68.8, so it was worse than expected. Inflation preliminary is 3.1 and the 1 year is 4.9. What if the liquidity hole is big enough? Well, you could try to trade across the range. I really haven't tried doing that. The thing about the liquidity hole NASDAQ killer that you got to remember is that it's going to be very difficult for you to get filled on the edges of the hole. And if you do get filled on the edges of the hole, you have a very extreme adverse excursion risk. It has been proven. So the study that you want to look for is like called Walrasian auctions in a continuous time auction, something like that. If you search for Walrasian on like SSSRN, I think you would find it. Or you can read Trades, Quotes, and Prices, Markets Under the Microscope by Jean-Philippe Beauchamp, where they talk about all of the empirically proven behaviors of markets. And we're going to make a video about it. So we've got this video that I'm hoping to put out. I've already recorded it. I need to finish editing it, where we talk about current conditions and how current conditions kind of affect how you might want to trade. And then we're going to go into the markets under the microscope stuff. Right. I have to say, like, then, and this is, again, here's my, I have like two contentions. It's kind of funny because I always want to be like, this is the thing. This is what we're about. You want to know what this channel is about. But it's so much more complicated than that. I have a hard time. Like, how do we market it? How do we market it? My take is we are informed traders. That's what we do here. That's what we do. That's different. We are informed traders. Most people, they want to be clueless about what's going on. And that's not our approach. I believe that the empirical evidence suggests that you want to be informed, that you're more likely to be successful if you're an informed trader. But it's also, how did we come to that conclusion? Through empirical evidence. So the book that I was talking about, Trades, Quotes, and Prices, Markets Under the Microscope by Jean-Philippe Beauchamp. So Jean-Philippe Beauchamp, he is the leading, well, I shouldn't say the leading, but he's one of the leading market microstructure researchers. And in particular, he is like the editor-in-chief, or like the main curator of the archive.org quantitative finance section. So if you've never seen that before, come over here. It's ARXIV. Made a TikTok about that this week, but quantitative finance. So arxiv.org/archive/q-fin. Quantitative finance, right? Okay. This is empirical empirically proven, peer-reviewed information about markets, right? Peer-reviewed information about markets, okay? And that book that John Philippe Bouchard wrote is like 30 years worth of empirical research summarized for you, right? Once you've read that book, it makes everything else look like trash. Like once you've read a real deep dive on markets that's based on empirical evidence, everything else is just so silly by comparison. Well, they sure continued through. Was there something about that consumer sentiment that really suggested that rates would go up? Was it the inflation expectations being a little bit higher than anticipated? I don't know, man. I don't know how up to date that book is. Well, it's so listen, if you don't know what the Kyle model is, for instance, and that's like 35 years old now at this point, okay, it's still just as relevant today as it was back then. And really, what all that's happened since then is we've just kind of refined our knowledge of it, right? The Kyle model kind of showed us how orders have impact. But then we found that a large meta order has a square root law impact, right? And so what you should do is you should read that book. That really gives you the base. And then when you come over to archive and you read the research studies that have been published this past month, and I mean it's literally there's new papers almost every day. You come in here, right? Here's ones that were released today. Stock market prediction based on bi-typed and hybrid relational market knowledge graph via dual attention networks. That sounds interesting. Stock movement prediction aims at predicting listed companies' stock future price trend, which is a challenging task due to how volatile nature of financial markets. Recent financial studies show that the momentum spillover effect plays a significant role in stock fluctuation. However, previous studies only typically learn the simple connection information among related companies, which inevitably fail to model complex relations of listed companies in the real financial market. To address this issue, we first conduct a more comprehensive market knowledge graph, which contains bi-typed entities, included listed companies and their associated executives, and hybrid relations, including explicit relations and implicit relations. Okay, so they're using informational content and they're putting it into their model. That's very good. Afterwards, we propose Dan SMP, a novel dual attention networks, to learn the momentum spillover signals based on the constructed MKG for stock prediction. The empirical experiments on our constructed datasets against 9 SOTA baselines demonstrate that the proposed Dan SMP is capable of improving stock prediction with the constructed MKG. Okay, cool. Look, there you go. But what you want to do is go and read that book and then come and read archive.org every day and see what they post. Right? Of course, it's not, probably the best information is, it's going to be at a firm. Like I tell you what, the people at Goldman Sachs knew stuff that was not in that book and that I don't understand at all. And that was like almost 8 years ago now, 6 years ago now. So surely they've continued to research and they've found even more things. Well, I really want to sort out why we got such a crazy hard change here. Does Zero Hedge have something? Maybe? I feel like we missed something. U.S. industrial production unexpectedly contracts in December. Don't fight the Fed. Retail sales, it doesn't make sense. Both current conditions and expectations fell in the January data, dragging the headline print down to 70.6 to 68.8. Current conditions are the worst since September 2011. Interestingly, buying conditions for houses rebounded in early January, but for vehicles, it crashed to a record low. And finally, and perhaps most notably, inflation expectations rose significantly in January, with medium-term expectations rising to 3.1, the highest since January 2011. Okay, but that was like not very different from what the expected number was. It could be that it was the consumer sentiment that moved us here. No, it was the same discussion that we're having right now, though, Lucas. Like, I just want to make it very, very clear. There's no hard feelings. We're still friends and everything else like that. It's just that what we're doing here is we are trading order flow and treasuries and trying to be informed traders. And, I don't think that Ace was on board with that, and it wasn't really contributing to our growth. And so it was appropriate that he go and do his own thing. Or, he decided to go and do his own thing. I didn't tell him to do that or anything like that, but he decided to go and do his own thing. And I totally support him in doing that. I think that he's doing the right thing. Right? And I'm sure that we're talking about him and it will somehow go back to him and maybe he'll come back and take issue with something that I say again. But my primary goal here, though, is to convince people why they should try to be informed traders. That's what I'm trying to do. And I know that you guys are going to all be skeptical about it because it's not the popular opinion. It's not what retail traders have been told. Retail traders, you want, and I get it. It's like you want the consistency, right? You want to be able to come in, do the same thing every day and consistently make money from it, because that's what you've always been told day trading is. And you know what? In 2001, that is what day trading was, right? But sometime between 2001 and 2008, the market changed and those opportunities aren't really very available to us anymore. And so my argument is that you have to go to the next best thing then at that point, which is be informed instead. If you can't compete with the robots, because your only other choice is to convince the CME to change the structure of the market so that you have a leg up on the robots in some way. Like that's what I was saying earlier. If you're a retail trader and you're trading under a certain yearly volume, then your orders go to the front of the queue. You get a handicap of some sort. Then maybe you could do that. But until that happens, I say that you're more likely to have success from trying to be an informed trader. There was a discussion about correlations. Oh, yeah, there was. Yeah, he was. That's right. Man, that one still kind of boggles my mind, where it was like, okay, you don't think that two indexes are highly correlated and that you could potentially make money from that if you're fast enough? You're more likely to find success in a 9 to 5? Yeah, sure. But I enjoy doing this. I want to do this. Listen. If it's about making money, listen, I said this in my last video. If you didn't watch my last video, you're new. Go and watch my last video, okay? If it's about making money, go to a code camp, become a software engineer. I have this friend on my feed, on my Facebook. Actually, oh my gosh, this girl. I owe so much to this girl, to be honest with you guys. Like we weren't like in a romantic relationship or anything like that. It was kind of a sort of thing where the situation where we were at and where she was at and everything, it was always just friends, sort of a thing. But she was such a good friend to me when I had just been divorced. Like when I was freaking out about everything that was going on, she was the one that talked to me and helped me so much, right? And she's kind of ADHD. I mean, she's never been diagnosed with ADHD, but when I talk to her, I'm like, man, this girl is so ADHD. And she's had a rough life. She had a kid very, very young. And I mean, she works and she's always had a job and everything, but it's always been very, you know, like blue collar kind of a job. I don't know what you would call it, but there's always been at the bottom rung of the economic ladder, which, and I feel bad because she's a really, really great person, right? And more recently, she learned how to code and is doing software development now. And oh my gosh, man, it is going to have such a crazy positive impact on her life because she's going to be going from, always living in the cheapest apartment available to being able to afford a home and, nice things and basically do whatever she wants because her kid is an adult now. It's in college. She can do whatever she wants now. It's going to have a crazy change on her life. Listen, if you're looking to make more money, learn to code. That's the easiest way to make money in this economy. And it's not just like you'll make money. That puts you in like the above average category of earners quite easily. And if you're a person that's into trading and you're listening to this stream, you can probably get quite far in software development too. So I would definitely look into it. But here's the thing. Somebody has to do what we do. Okay. I'm not just going to let the robots do everything. I'm not. I don't think that it's good for the market. I think that somebody needs to be in here that knows what's going on. They understand the market, they understand the market microstructure, and they understand the current happenings in the situation, and they can make predictive calls about, it's speculation. Yes, it's speculation. It's not arbitrage. It's not market making. It's speculation is probably what I would term the kind of trading that we're talking about doing. But somebody has to do it, guys. Somebody has to do it. And I want to do it. I love it. That's my calling in life. And even though I do think that in the future, the stream will continue to evolve. And like I said, this year, I'm trying to put more emphasis in the stream because I think that this is information that's important for other people to know. And we really want to get our message out. And if the stream is successful, we might have, there may be some other evolutions, like we may end up playing longer term sort of swings more often, but I'm always still going to be here trying to take little scalps with these micro contracts based off of news and so forth. Always. Somebody has to do it. So yeah, are you more likely to find a success in a 9 to 5? Yes. If you're looking at day trading as a career, go do something else. Unless you're like still in college. Okay. If you're still in college, go and major in some sort of a finance degree and go to trade for an institution. And hey, for us, I don't know how to find it, but I'm keeping an eye out. Maybe there will be some opportunities for some of us to go and join firms and stuff. Maybe there's going to be some commodity firm out there that's going to say, well, you've been a retail trader for a long time. Yeah, you might not always, take the best trades, but we'll find that experience valuable and, you do execution for them or something. Maybe. There might be some opportunities like that out there for us too. Even if you haven't been to school. So I don't want to imply to anybody that going to a code camp is the same thing as getting a 4-year computer science degree. Okay. But the person that gets the 4-year computer science degree has the ability to go in and create new technologies and work on the bleeding edge kind of stuff and make really complicated algorithms and so on and so forth. Okay. But there is this huge swath of work out there that is just making websites in React for small companies that there is just not enough people out there doing it. And if you know how to do React, you just go to like a 1 month code camp, or maybe even less than that, maybe even a week. You can make good money. Finance degrees might be trash. So from my own research on this, where you go probably matters more than the specific degree that you get. So if you're at the right school, you could be majoring in finance, quantitative finance, or math, physics, statistics. Those are all probably reasonable ones. But you got to be going to the school where the company that you want to work for is recruiting. So where you go probably matters more. And if I was going back into school, I think I would be trying to go to these schools where they have really strong market microstructure researchers. Hey, Aditya, how are you doing? Always nice to see you in here. Okay, well, we avoided a really awful. I mean, we took a loss. It was only like $10, right? Yep, not too bad. But I want to know, what was the price that I got? Need to take this off. 21. Yeah, see, my original position just wasn't very good. If I had waited for the liquidity hole to form, I really thought that was going to be news that they were just going to pop off with, right? But if I had waited for it to come back here, and then maybe I could have gotten a good trade, and I might have been able to have pulled something out of it before things turned to shit. But man, from here we avoided, by choosing to get out when I did, that went another 20, 30 beyond that. Wow. Although, and this is kind of really weird flow, because obviously we want to be informed traders, but sometimes it's just really hard to be the informed person, right? Maybe at the end of the day I'll be able to sort it out, but right now I'm a little bit surprised at the way that this went. Started turning around after 7. I mean, the timing was in line with the news, right? Like where it kind of topped off and then started turning down was after the industrial production news. And then there was another further decline after the consumer sentiment. When I look at those pieces of information, I don't see why those caused the market to move the way that they did. I actually kind of look at those two pieces of news, like the retail sales is one that's like, okay, that's really bad. That should push treasuries up. The other pieces are like, seem like they're in line. And so what's causing the movement has to be a more subtle nuance about it, right? But what that is, I just don't know at the moment. Well, I'm already doing that, Lucas, but I'm not going to sell it. So you haven't watched my order flow videos, have you? Oh, actually, I think you did watch at least one because you made a comment, right? I've been talking about order flow. I'm very focused on just kind of trying to explain the things that you're going to tend to see and why they tend to happen, rather than trying to give you some sort of a setup. In the video that I intend on putting it on Tuesday, we're going to talk about the Santa Fe model and how you combine, what are market orders doing, what are limit orders doing, and what are councils doing to kind of weigh up what the different forces are into a model of what the current conditions are, so that you can decide how to trade it. And so that's going to be really useful. And then we're going to talk about the empirical properties of markets, right? So, and that will kind of finish off our order flow series. So that'll end up being like what, 5 videos, 5, 6 videos. Well, I originally learned how to read the DOM from Jigsaw. Well, not from Jigsaw, primarily from um, the No BS day trading, which is still a good course. It's cheap. It's only like 70, $90 now. I highly recommend it, actually. I would, there are some setups in that course, and I just tell you right now, if you just are trying to straight trade those setups, you know, you won't necessarily be a profitable trader, but it's still really good information. Like, it still gives you a really good idea about like what is going on in the order book and how to approach it. Jigsaw, if you purchase Jigsaw, you get education included with it. They recently updated it. I haven't seen their updated education, but it's a very, their previous education was a very, very thorough explanation of what order flow is and what you're looking at, right? And then again, I am making my own videos, and the videos that I've made are advanced knowledge, right? I'm giving you a lot of things about how you can use the context to kind of sort out what kind of flow you're going to see, or what kind of flow you're seeing, to try and sort out what might have caused it. They claim some huge prop firms use those courses. Yeah, I don't know, man. Like, again, once you've read markets under the microscope, everything else just kind of seems like child's play. I think that the order flow courses at Jigsaw are very thorough and really effective pieces of education, because order flow is kind of hard to get at first. I don't know what it is about it, but when I first loaded up the DOM and I was watching things, and I'm seeing, there's market orders, and like, I understood this is a market order and this is a limit order, but I really didn't understand what I was watching, not in the way that I do today. And it really took like watching those Jigsaw courses and coming back and watching the action and going back and watching those again to understand it. So I can totally see why, Jigsaw could brag that prop firms use that education and that it's a really good education, because it really is a really good education, and it is going to save you time, but it's not going to make you profitable, right? You need more than that. You need more than that. Where are you going to find your edge, right? And that's kind of where I come in, or that's what I'm trying to help you guys to do is, okay, if you want to find a statistical edge, then I'm going to show you how to program so that you can try and do that research on your own, right? Or you can go the easier route and you can try and be an informed trader. And so then I'm going to teach you, here are some of the pieces of information that we keep track of that are useful and, help expand your understanding of markets. So I want to write a book, and that book is going to be informational stuff. It's going to be like, okay, here's the different reports. Here's everything about those reports and what that data actually means. That is going to be that sort of stuff if I make a book. Say that the Jigsaw's education new format is better. Yeah. Well, it looks like they're much better produced. I'd never heard of the guy that they had to do them, but that's why one of the things that I point out in my videos on this is that, like, this is not intended to be a replacement for like the Jigsaw or No BS day trading courses. Like, I'm sharing with you information that you're not going to find anywhere else in those videos. And there may be times where the significance of those things might not dawn on you, but eventually it will. Eventually it'll be like, you'll see a big order and be like, oh yeah, Seth said, at the beginning of the session, you'll see a big order and be like, oh yeah, Seth said sometimes they'll stir the pot, right? That's probably that's probably I 100%. Well, how do I say this? I'm not surprised. Live Action, Live Action said that one of his brokers said that he did not see an advantage to order flow to client accounts. Not saying he is right, just sharing. It's probably accurate. But you know why that is? Because even if you're looking at order flow, the vast majority of what you're looking at is noise, right? Or rather, past orders are not very effective at predicting future orders. They're just not. I've never found something that shows that past price, past orders, past anything is really truly predictive of future returns at all. The only thing that I've ever seen that has real backed evidence of predicting this, of predicting future orders rather, is news and sentiment. And there's research studies out there about news. Like there's these studies where they aggregated Twitter, for instance, and they were able to predict future orders with Twitter, right? Past information. Well, the older the piece of information is, the probably the less useful it is, right? But yeah, you're gonna see, like, again, retail traders come into this and they think, I'm going to just come in and I'm going to find this consistent thing that I do every day and I'm going to trade and I'm going to make money from that. And they think that because that's what all of the stories that they heard about traders when they were growing up. And the problem is that what traders when they're growing up in the 80s, 90s, and 2000s, it was a very different. It was a world before computers came in and ruined everything. Like, I'm telling you straight up, the robots ruined market making for humans. The way that the market is set up right now, it is extremely difficult for a human to be profitable. Now, don't get me wrong. Even back then, it was crazy hard. Okay. And most people still failed. Okay. But there were people that made it. And we know their names even. Okay. But these days, it's like it's nobody. Nobody's really making tons of money from market making. They really just destroyed that opportunity, right? So all of these retail traders, they're coming in and they're just buying courses from other people and just following other people's methods without any evidence that it's actually going to be effective, right? I mean, nobody has a 5-year track record that I've ever seen. 5-year track record. And most people don't provide any stats about their performance at all. The most popular, I think the most popular thing that I see out there is price action. And none of these price action educators show any kind of stats or anything like that. And there are people on YouTube, but man, some of those people on YouTube we've seen like blow out in the past year, like crazy hard. So they're in the same boat that the rest of us are in, right? But people follow it because our tendency as humans is to look for signaling, right? We look for wealth signaling and we go after the person that's giving off the most signals that they're being successful. That's the way that like we've evolved, is watch other people that are doing the things successful and copy them. It doesn't work in a competitive environment. And an environment as competitive as trading, that doesn't work. You're going to have to do all of the work yourself. You're going to have to learn something and find something that nobody else knows. So the vast majority of traders, whether they're using charts or they're using order flow, are going to fail because what they're doing is just noise. It's nothing. It's no better than noise. Because again, markets are very statistically efficient, right? So, and the people that are making money, like they'll make money a little bit and then they'll lose it. They're primarily taking on risk.
You got to understand that thing too, right? That's a big part of what's going on. Okay. Very, very few people are actually trying to trade news and fundamentals and everything. And I'm not saying that you trade news and fundamentals that you're guaranteed to make money, right? But I'm just saying you probably stand a better chance, right? Probably stand a better chance. You're more likely to break even or make a tiny little amount rather than just completely blow out like most people do. That's what I'm saying to you. So yeah, it doesn't surprise me at all. And again, because another part of this is that even though order flow is really critical information to be watching, it's not very predictive. I've not been able to find predictive signals with it. So it's only one part of the puzzle, right? The people who make money keep their mouth shut. Well, there's that too. But um I'm telling you, like from the research that people have done on these sorts of things, and of course, nobody's done it on the US futures market, but I would be very surprised if the stats came out any differently. Okay. Like 95% of people fail. And even if you look at people that trade for 5 years, at the end of 5 years, 70% of those people are still going to be unprofitable. And maybe 1% of them will have made like actual significant profits. How did you use order flow? So why I'm using order flow is I want to use it to, one, understand the current conditions. Okay, so like if liquidity is really low, I don't necessarily want to be taking adverse excursion when that happens, because it's going to be easier for the market orders to go through you when there's not very much liquidity out there. Or, they're also, when market orders are dominant, they're going to create those liquidity holes. So you got to be aware of those, right? And two, we want to use the order flow to understand what has happened. If you're just watching a price, you don't completely understand how it played out. So you don't completely understand what happened, right? Once you start using order flow, you can come in and you can say, okay, well, that move was driven by that piece of news and it created a rush of market orders. And this move looks like this was pulling caused by the dollar strengthening, and right. And you can form a much better picture of what happened. And if you can form that better picture of what happened, then when you're in a trade, you can then say, oh, okay, well, I saw that flow that was not in line with what I thought was going to happen. So I'm out. Just like we did today. We took a bad trade, but I was a little slow on it, but we saw the flow it wasn't doing what it was supposed to do. So we got out. But I wasn't because I got some signal or something like that. It was because I knew what the flow was supposed to be doing, because I had a predictive piece of information and it didn't do that. Do you see now how it's different from using order flow as a signal generator? You may be able to use order flow to optimize your entry. For instance, if you get in on an iceberg, because that's an area of higher liquidity, it's going to be harder for them to move through you. If you take it as she goes, you have a slightly higher chance of having the momentum with you, because you're at least you're able to eliminate the statistical disadvantage of the spread, right? You can look for liquidity holes and try and optimize your entry from the liquidity holes so that you don't end up taking a price that's, like a bad price. The worst is when they're trading a range, you think that they're going to go up, you buy 13, and that's the price that like they can't get through, right? And you never ever get any favorable excursion, right? That's what you want to avoid. So you can, it helps you in that respect. But what people want to do is they want to say, in X situation, when the market's like this, and I see this particular pattern in the flow, then I'm going to buy it, and it's going to
work out 50% of the time, and I can put this stop and target on it. And right, that's what we always think of, right? That's flawed thinking. So what's flawed with that? Well, number one, there's no evidence to suggest that any kind of setup with that, even if you put a lot of filters on it about what the current conditions are and the context around it and things that are probably really hard for you to empirically test, but that maybe you can see it in, you notice it as a person, right? Um, we have no evidence to suggest that any of those things are very predictive or hold a statistically significant edge in like win rate or favorable excursion that you'll get from them. And in order to prove that there is a statistically significant edge in those things, you would need a lot of samples, because what happens is, say you've got this sample, right? Well, let me use Nassim Taleb's examples. One of the claims that has been made is that there is less violence. That like we're not having big wars anymore, and so violence has decreased. Well, the problem with that thinking is that you only get a major war like once every 70 years. Once every 70 years. So you can't come in and say it's been 70 years and there's been no war, that there's been a change, right? We would need at least 3 times that to say for certain to have like a statistically significant chance saying that there's been a change, right? So it has to do with like when you get those outlier events, how often do they happen, right? Now, there's another problem that comes in that's particularly relevant to us in day trading, and that is that there's clustering effects too. So if, for instance, the average range of a 5-minute bar is 4 ticks in the treasury, right? The vast majority, like 80% of all of these samples are going to be within that range. But the ones that fall out of the range, one, there's going to be some that are like a way, way, way bigger range than 4. There's going to be ones where the range is like 64. Okay. And when you get those bars that have the big range, you're more likely to get another one. They cluster, right? So you will think that you have a statistical probability of something happening until you come into that cluster. And you would have to go through that and come into that cluster 2 or 3 times. Maybe probably even more than that. And I mean, really, like for the sort of thing that we're talking about, you would really, if I was doing a back test, I would really want tens of thousands, hundreds of thousands of samples, right? So I'm not saying that you can't trade it. You just got to realize that you're doing it based on faith, because you really don't have the empirical evidence to back that trade up, right? U.S. has information that indicates Russia has propositioned a group of operatives to conduct a false flag operation in eastern Ukraine. Wait, boy. FDH says, I strongly feel that there ain't going to be any rate hikes in the first half. Well, I'm not going to say that your opinion is crazy. So you mean to say most of us will not make money? 95% of you are not going to make money. Even if you do it for 5 years. Just I have to be honest with you guys. That's just what the data that we have says. If there's some sort of method or thing that increases the number of retail traders that are successful, then I will be the first person to tell you guys about it. Okay, where is the empirical evidence to back up an informational edge? So what I do not have, and what I would like to see some research on, is some studies saying that traders who rely primarily on informational edge on average tend to perform better than traders that try to rely on a statistical edge. I'm going to bet, my theory is that if you do this study, you study traders over a 5-year period, and one group of traders, they are only using charts or order flow. Actually, let's split them into 3 groups. One group only uses charts. One group uses charts and order flow, or they're watching the DOM, and another group tries to be as informed about the markets as possible and tries to incorporate informed trading into their strategy. And my theory is that the ones that are incorporating informed trading, that probably the majority of them still lose, but that they on average would perform better than the other 2 groups. That's my claim. And there isn't a study on that. Okay, there's not. But the reason that the empirical evidence that I do have to back that theory up is what we have learned about markets in terms of, like, now that we know that orders move markets and we can kind of measure those things. We have discovered that the markets are very inelastic. And so even when you look at the markets and it looks like a random walk, that's all of the studies that we've done about this. It looks like a random walk. But then when you try and look at, is the market efficient? Well, so we know it's statistically efficient, but if we split that out to informationally efficient, does the current price factor in all currently available information? It doesn't, because there's more movement than there is changes in information. Where does all that excess volatility come from? Well, it comes from the orders, of course. I mean, we all kind of know that, right? But these researchers have been doing a lot of research around this thing, and the conclusion that they have, and I'm would still posit as a theory. Okay, it's not proven, but the best evidence that we have right now suggests that markets are more statistically efficient than they are informationally efficient. Okay, so if that is true, it should be easier for you as a retail trader to find an edge through informational means. Right? Doesn't mean that it's perfect. There's some disadvantages, right? The primary disadvantage, there's 2 big disadvantages that I can think of, but the primary disadvantage of informed trading is that you always have to work at it, right? It's not like you can just look for that one thing and that one thing will always work. Every day is going to be different based on the context, the conditions of the market, and what the news is. And every piece is going to be different. And so that's hard, right? The other difficulty with it is that you can just be wrong, right? If it's a statistical edge, then you can just put in the qualifiers and it should be a straight yes or no thing, whether it fits your entry parameters or it doesn't. But with an informational edge, you might have an interpretation of the data that is just straight up wrong, or is not what the majority of the market believes, or it doesn't end up predicting the orders, like what happened to me today. There's clearly something's going on here. I think that those moves that we've seen in the order flow suggest to me informed trading, but I don't know what that information is, right? I'm not the informed one, and so that's where you get the disadvantage on that side. So I would say probably still most traders are still going to fail, but I think that they would perform better on average. Yep. And I do know there are some pretty big traders out there that do trade off of news. So, but they also do market making. If you're really, really big, you can kind of do market making kind of stuff. So I don't know. Just realize that market making is taking on risk. Well, I suppose that's another really big caveat to everything that I'm saying here, is that the easiest way to make money from trading is to take on risk, but that it only will make you money in the short run, not the long run. I would speculate that that was appears to make information more predictable is the volatility that is associated with it. Um, let's put it this way: there's more information out there, that should result in more volatility. Because one of the problems that we have is that not everybody interprets the information the same way, right? That's also why when we get into periods of extremely high volatility, that it's probably better for us to just kind of stay out, right? Like that oil trade was a good example of that. Like we had the edge there for sure, but because of the volatility, it just we weren't really able to take advantage of it, and trying to do so was very detrimental to us. You can't make money with the price if the price is not moving when there is no information. Well, yeah, yeah. Price does tend to move a little bit though. It's just the fat-tailed nature of it. I need to go back, and I'm trying to understand. So I've been trying to read more Taleb stuff on this, because the key thing that irks me still is that people say, okay, you want to, watch what the range of a bar is, or the harmonic rotation, and then if it's gone further than that, and there's not some sort of news or trend or something pushing it that way, you want to fade it, right? And if there is some sort of piece of news, that's the breakout, and you want to go with it. And that sounds to me like a naive interpretation of the statistics. And so, what I want to know from the sort of stuff that I've been reading about Taleb is, how many samples do you need? Apparently, from what I was researching yesterday, a lot of it has to do with what is the average time between those extreme events. And then based on that, you can sort out how many samples you need. Um, but I'm not quite sure what the deal is with it. And the same thing with like, okay, when you have a fat-tailed distribution, standard deviation is not really a useful metric for it. To say that this is outside of the standard deviation, so most, you know, you should be able to fade this, and most of the time it will still work, or whatever the deal is, doesn't doesn't work. Like the standard deviation is not as useful of a metric for a fat tail distribution. So what's the other tool that you use? Is there a point at which you want to say, based on the range, that we should be able to make a decision and have some sort of statistical edge, even if it's, um, protecting you against adverse excursion, or whatever the deal is? Uh, I don't I don't know enough about statistics. I just know that when I go in and I backtest these things, they don't work. Well, I'm not sure what you mean there. You never analyze information and come into the market and trade after to move, as already happened as a retail trader, right? Question mark. So if I come in and I have an idea, so for instance, today's idea is that retail sales are going to really push us up. Okay. I might not necessarily take the trade, long before it happens, because the earlier on in the trade, the better it's going to be for you, right? But the earlier on in the trade, the greater the probability is that it doesn't actually happen, right? So you don't necessarily want to be the first person to take the trade. You want to see a little bit of order flow to confirm that you're seeing the orders that you were predicting. But you would still want to take it early, right? That makes sense. I hope that answered your the question. That was, or if that was the question. Can we say at the moment the market is in an accumulation phase? I'm not sure what's going on right now, dude. My gut check is that it was the JP Morgan thing, and that they're making some sort of interpretation of the news that suggests that the data that we had doesn't change the probability of the Federal Reserve raising rates. So there's some complicated reading of this that's beyond my own understanding. I only lost $10 on it. I'm okay with that. And maybe we can come back on. So what do we get next week? It's almost time for me to get going. So let's just look at what we've got. So we got the bank holiday, and then housing starts, Philly Fed. Okay. And then for the last week, then we get like a FOMC statement. And GDP. I personally, I don't think that it's as simple as some people are making it out to be. Like I feel like that we have priced in, well, I don't know. JP Morgan saying that it's going to be more than 4 seems really out of line to me. I really want to know what it is they're seeing that makes them think that it's going to be more than 4. Because if the inflation is driven primarily by supply constraints, then yeah, slowing the economy down is going to help with that inflation because it's going to slow down demand, but you're going to create a recession. And once you create a recession, the need to raise rates anymore goes away and turns into you need to lower rates, right? So if we really get this slowdown here at the beginning of the year, the market is not pricing it in well at all. Because if we're really going to get a slowdown later in the year, then the news that we got today is probably your first and best signal that that's what's going to happen. So it moving the way that it is right now is kind of a little concerning. But we give it a weekend. We'll come back on Tuesday and we'll see if things have changed. Maybe we'll get some more information. Maybe we'll understand it better then. And we'll get better better trades. Have you ever backtested a simple moving average that places a trade with the trend only inside the news? I'm not sure how I would do that. I've never been one of the things that was kind of on my list, but I've never been able to work out is finding a feed that shows me the news so that I could backtest things historically with news. I think that would make a big difference because then I would be able to come in and say, okay, yeah, like even if retail sales are horribly bad, it only has this much impact or this is how much it moved. So maybe it's not actually as great of a trade as you thought it was, Seth. Because that's basically what happened today. I have to say that the movement in treasuries here today is a little weird. But I'm gonna blame Jamie. Hey Jamie. I'm a big fan, Jamie Dimond. But fuck you today, all right? Because I was really into that trade. All right. Hey, I got to get going. Again, I'm not going to stream on Monday. I'm going to take the holiday off and to create content. But we will be back on Tuesday. So see you guys then. In the meantime, stay profitable, friends.